What we'll talk about today is a business owner who's interested in a very large whole life insurance policy. And the reason why is because he wants to be able to use this policy to finance large expenses and opportunities for his company instead of working with a bank. So what we'll look at in today's video is his actual policy. We'll see money going into the product, what the cash value looks like, and how he plans on using it with loans. And then we'll go over the drawbacks, what we don't like about it, but then also what we do like about it and why a lot of people do this. So a little bit on the individual. He is in his late 40s. He's a doctor. He actually owns a sports medicine practice that treats high-profile professional athletes. He treats a lot of people that are in the MLB and NFL in the Northeast region of the U.S. High-profile stuff. Really cool, too. When I got to talk to him about it, he was sharing a little bit about what he does. Then I went on his website and saw some testimonials from some big-time ball players. I'm like, that's really cool. But I like sports, which is why I say that. But what he's interested in is using a whole life insurance policy for his business because he does not want to have to work with a bank anymore. He's tired of dealing with underwriting, renewing credit lines every year, and then seeing interest rates continue to go up and he has to pay it back at their term, loans that he has outstanding. He's like, I don't want to have to deal with that. I'm interested in seeing how I can really have my own line of credit or be my own bank with a whole life insurance policy. Show me how this works. So we'll get into his exact situation. A little bit on him. He's in his late 40s. He's looking to fund a large life insurance policy. The dollar amount he's looking at is $800,000 per year. Now, if that sounds like a lot of money, it is. But what I'll say about that is, if you're looking at this and saying, hey, that's just way out of my range right now, you can literally chop a zero off or chop 2 zeros off, and all of the numbers you see will still apply to you. As long as the policy is set up the same way, it doesn't matter. So we've got $800,000 per year for 5 years. So that's a total of what? 8 times 5 is 40. That's $4 million. And what he wants to do is get $4 million into the policy, have it compound for him forever, and be able to use that as his own source of financing for business opportunities as the years pass. So, why whole life insurance? A question that comes up here a lot is, why would I not just use a bank? Meaning not take loans from a bank, but if I just get $4 million in my bank account, I'm good. Whenever a purchase comes up, I can just take some of that cash, invest in my business, and I'll refill the bank account, because that is what he has been doing, and it's what a lot of business owners do. So let's go through this first, and we'll use a simple example here. Let's assume that you save $100,000 in the bank. We'll just use a 100K example, and we'll go through this, and then I'll compare it to a whole life insurance policy, and this will explain why a lot of people do this. So you've got 100 grand in the bank. We're earning 5%. Okay. You see a business opportunity, business opportunity, and you need $50,000 for this. If you purchase this piece of equipment, let's call it, it's going to 10x your revenue potentially. You say, I got to have this. It's going to help my company more than anything else. So you've got 100 grand in the bank. So you take $50,000 from cash that you have and purchase this equipment. All right. So we had $100,000. Now we subtract $50,000. How much do you have left over in cash? Simple math, right? $50,000. What's earning interest? $100,000? No. $50,000. So that's earning 5%. What you did is give up 5% interest on 50 grand to earn a much higher return than that by putting the money in your business, which is always the way to go in my opinion. So that's using a bank. What if I use a whole life insurance policy instead? Why do people do that? I'm going to show you exactly why right now. Here's the appeal. If I take that same situation where I have cash value, instead of money in the bank, we're calling it cash value of 100 grand, and it's earning the same 5%. Okay. I see that business opportunity roll around. It's going to cost $50,000. I want that. So what I do is pull money from my life insurance policy. So I've got the business opportunity down here. Sounds good. In order to get that money, I'll take it from the cash value. And how I'll do that is with what is called a policy loan, which you don't have to qualify for. When you request it, could be through your online account or mobile app. It typically hits your bank account in 2 to 3 business days on average, direct deposit, very, very quick. So you took 50 grand, invested in your business. There was a cost over here. Let's say that's also 5%. What do you have left in cash value? Well, if I do the same thing I did with the bank up here, cash value, let's call it equity, which would be money that you can still access, would be $50,000. If you go back up to the bank example, when you had 50K left over, that's what you earned 5% on. With me? What do you earn 5% on down here? Is it the 50K that's left? No. You still get 5% on the full $100,000. This is exactly what he's interested in. Because with a life insurance policy, once a dollar passes through the cash value, if I let it sit and grow, I get 5%. That's what it's growing by. In this example, if I pull 50 grand out, I still get that 5% earnings on the full $100,000. So the entire cash value continues to compound. Now, how that works for the insurance company is, one, they are charging interest on the loan. That'll offset the fact that they are charging me interest on everything a little bit, but then they also collateralize the death benefit. Meaning if you die with a loan outstanding, they're going to pay out the life insurance amount to your beneficiary minus the outstanding loan. We're going to look at an example in a little bit. But that's why he's interested in using a whole life insurance policy. And this is why a lot of business owners use whole life insurance once they get it and understand how it works and really see the numbers for them and what it looks like when I pay money in, borrow money out, don't pay it back in full, when they can see the different scenarios. That's extremely important. So let's look at the different scenarios for him. I just want to wrap up this strategy. So he wants to fund it aggressively for 5 years. During the first 5 years, here's what he plans on doing. First 5 years, he is going to be taking loans. And he's going to loan close to 80%, a little bit more than that. So let's just call it $3 million. I know that's not 80%, but we'll keep it simple. So he'll take out loans over the first 5 years, call it $600,000 per year. He's borrowing against the policy. He's using that for his business. But what's going on here is when that money is outstanding, so he put $4 million in, he took $3 million out, but he's still earning interest on the full $4 million. His plan, call this step B, is during the first 5 years, just going to do it this way, he'll pay interest only. So he's not going to repay those loans at all, none of the principal, but he doesn't want it to compound because he can choose if he pays interest or not. What he'll do is pay the loan interest annually, and then C, beginning the 6th year, he'll pay the interest plus the principal. But he can do this with ease because is he paying anything into the policy anymore? The $800K per year, let's call this the funding, has stopped. So this is something a lot of people really like to do, aggressively fund a policy up front, get a big bucket of cash value that's compounding for me, really aggressively borrow against that policy while I'm funding it, but I'll do it for a set number of years. Sometimes it's 3 years, 5 years, 10 years, till a certain age. It depends really on what the individual wants to do. But then after that funding period has passed, we have this large loan we want to service. So now, since we're no longer funding the policy, we can take the money that we would normally use to fund it to then repay the loan. This way, we don't feel overextended or stretched where I'm trying to fund the policy and pay the loan. And the only way that works is if my revenue and profits go up and up and up every single year, which should happen if we're in business. But does it happen every year, all the time? No. And even times when revenue goes up, profits go down because you're still learning, you've got expenses, whatever it might be. Like that's going to happen all the time. So let's take a look at these numbers. We're going to look at first money going in, and then we'll look at the actual loan scenario. So let's start with the illustration here. And as we look at this guy, we won't go through all of the details here because I'm going to pull it up on Excel. But here's what I want to hit on. Annual outlay is the money going in. Net cash value is his money column. The death benefit is over here in the far right. $800K per year. Does he have to pay this every year? No, he does not. Here's his minimum. It's technically that, plus that. So call it about $90,000 per year. And then he can add the rest if he wants to. He's got flexibility. So when we set these policies up, what we do not want to do is set someone up in a situation where they're on the hook or committed to making this big premium payment every single year. A lot of times people don't like that. So let's go through the policy here, and we'll start with this guy. So what we just looked at is as follows. We've got the minimum of $80,000. That's the true minimum premium. Then we've got our PUA rider. This is how we maximize cash value. Quick side note on this, if you're new to whole life insurance, premium dollars, typically, regarding your cash value, do not build any in the first year. And then beginning the second or sometimes third year, start to come back to cash value for you. Whereas PUA dollars do show up in cash value in the first year, begin to compound right away, and this gives us access to capital right away. This is the key to accelerating cash value growth, by the way, short-term and long-term. So what we're doing is minimizing the premium. Typically, we can minimize it as low as 10% with some of the top insurance companies. Net out of pocket, $800,000. Total funding, this tallies up the $800K per year for 5 years, $4 million. There's your cash value. What's highlighted in yellow represents the break-even point. So at year 4, he's got more money in cash value than what he paid in. And then you've got the death benefit. Now, what this represents, this is the 8th year. When you see this drop here, policy year 8, this is optional. For folks that say, I don't care about the death benefit, I'm interested in the cash value, this is a really nice option to be aware of. So the earliest I can drop the death benefit without triggering a taxable event, because remember, if we do everything right, we can access that cash value tax-free. That's another huge point of attraction to these products. But with that in mind, the tax-free piece, the IRS has a 7-year rule where I cannot drop the death benefit until at least year 8. And this is in a case where I'm not paying anything in. So to show you the bottom line with this, let's go back to our illustration. We can actually look at a section here that shows the 1-year rate of return. Here's your funding, $800K per year. Ignore this column. This guy. What do you notice? Years 6 and 7. when you don't pay anything in. There's the net rate of return. This is just isolating the net growth rate, 4.62%. Next year, 4.63%. Then look at this. It jumps to 4.96%. And then it gets even stronger as time passes. What we did here was reduce that death benefit. By reducing the death benefit, we're reducing the costs and allowing the cash value to grow at a faster pace. Okay, so I just want to mention that because that question comes up quite a bit. Let's continue on. Now that we see the policy growth, let's look at loans. So where we'll start is the same growth illustration we just looked at, $800K per year for 5 years. We're going to follow through with his exact plan. Got the same policy here, $800K going in. Then we've got loans coming out at $600K per year. He can start in year 1. We started in year 2 because the earliest we can illustrate loans in the software is beginning year 2. So it's a software limitation. We've got the loan balance. Now it's not increasing because what you'll notice here is here we've got his loan payment. So in light blue represents what he is paying in either loan principal or interest. When he's taking those loans out, we've got the interest that's billed from the insurance company, and then we've got what he's paying. So each year as it's billed, he's paying interest only. He's funding $800,000 and paying that loan interest. Side note, when we first discussed this strategy, he actually wanted to pay more than $800,000 per year into the product. In talking with him though, I wasn't comfortable with that. And the main reason why is because looking at his revenue and really his company profits, $800K he can do, and he's not going to have any problem funding that, paying the loan interest, and addressing the loan principal later. Going higher than that, if him and I flip positions, where I would struggle is if I feel like I'm overextending myself and just stretching too much, paying the funding amount and the loan interest. If I find out, oh man, I got to reduce my funding, it's not going to perform at the same level, and it's not going to feel good. That's where people typically have some type of regret or end up taking their foot off the gas regarding the funding, and it doesn't perform at the highest level. So in a case like this with a large dollar amount going in, I'd rather start a bit more conservative regarding how much he wanted to fund. And if he finds himself funding $800K and paying the loan interest and he's got all of this extra cash, well, then we can look at another policy on his wife, which we had discussed. So we can kind of save that on the back burner for after. This way we're not overdoing it with this particular option. So he's paying interest only. You see in purple, what's applied to principal? Nothing, because we're not paying the principal yet. And then we've got the cash value and death benefit. Next, what do we start here? In the 8th year, we begin to pay $500K per year net. So he's funding nothing out of pocket regarding the funding. He stopped making interest-only payments. He funds $500K, and then we see he repays $500K, and we see how much is applied to the interest and how much is applied to the loan principal. So when he's doing this, what do you notice about the cash value? It's coming up. What about the death benefit? It's coming up. If we look at year 6, loan balance, $3 million, look at your cash value and death benefit, and compare them with this. It's $3 million less. That's what's going on, approximately. The loan interest is withheld too for the cash value. But my point is, when you have a loan outstanding, your available cash value that you could borrow and your death benefit is going to be reduced by the amount that you can pull. However, you're still getting growth on the full cash value. So everything continues to compound. And when you pay it back, this example by year 15, look at your cash value death benefit and compare it with what you have over on the left where you never touched it. What do you notice? They're exactly the same. you receive the compounding all the way through. That specifically is what he was interested in, getting that constant compounding all these years. Now, here's the last thing that I would look at in a case like this, because this question comes up a lot with business owners, and if it doesn't come from the business owner, it comes from their accountant or an advisor of theirs, which is, all right, I get the idea that the money keeps on compounding. That's great. That's why we're interested in this. But we would not be interested in it if we found out that what we're paying in interest greatly exceeds what we're getting in earnings. I don't want to just blindly say you get this constant compounding, so you should just pay more in interest now because you have more money long term. It's like, no, you got to look at the numbers and see if it makes sense, right? So, what is the actual cost to borrow? We can see the loan interest there, but look at this. Yearly cash value growth. This is going to isolate what your money is growing by net year over year. So the first year, look over here at the left, you're paying $800,000, you have $718,000. That's a loss of $82,000, no matter how we slice it. At the end of the first year, you've got $718,000, you pay in $800,000, it's worth $1.494. If you just add 800 to 718, we would have 1,518. We've got less than that. Meaning of our 800, we did not get all of it back. We ran a loss that year of $24,000. Make sense? This is important to look at. Year 3, the growth, $38,000. The reason why is because you paid in 800, you got that back, plus another $38,701. This represents the net dollar amount that's going from the insurance company to you. What this also shows is what we looked at here, that 1 year rate of return. It's the same thing, but just in dollars. I like that a lot more. But now you've got the growth, and compare that with this. Money in, meaning money you're getting, versus money out. Now I can compare year over year what the insurance company is paying me total and what I'm paying them total. So this isolates the yearly cost and the yearly growth. So in year 3, I'm slightly positive, almost a wash. Year 4, I am positive. I get stronger and stronger each year. The reason why is because we're paying interest on this, just the loan balance, but we're getting interest still on this at the same time. And if you take a larger loan, those numbers are going to be different, which we just run those numbers. We've got a loan workbook that our clients can play around with as well, so they can see this firsthand. That is so important when it comes to loans. Like, this is what always comes up, transparency around the numbers. It's when someone gets involved with this strategy because they just hear you're earning a 6% dividend and your money compounds for you forever, we get excited, put a ton of money in here, and then we find out, wait a minute, the dividend rate is not what I'm actually getting here. Like, the net growth is different. So now my numbers are different and I'm in the red. No. We want to make sure we're always not in the red and we're in the black. I hope that made sense. I think you get the point. So that's a yearly basis. Then we can also look at this, the total interest we paid over time. I love looking at this. Look at that finance cost. But look at the money earned, more than double. So it made sense in this case. So the purpose of this video is to demonstrate what he's specifically doing. We see a business owner putting a large dollar amount into a policy, $4 million, but why he wants to do that is to have $4 million compounding for him forever. He wants to be able to immediately use that money for his business because that's what earns him the highest return. Then while he's using it, he wants to pay the interest. This way, he doesn't feel burdened to have to repay the loan and fund it at the same time. He said, I'm okay funding it and paying the loan interest during the first 5 years. After 5 years, I'll stop funding it. Maybe I'll pay a minimal amount, but I want to stop. and dedicate all of my resources and attention to repaying that loan, which at that time, he could still be borrowing money out and using it for his business. The point is, he's got a big bucket of cash value that's compounding for him. He can use as his own personal line of credit. He doesn't have to worry about loan terms with a bank or anything like that. He's in control. And if he does everything right, meaning the agent doesn't mess the policy up, he can use it all tax-free, which when he's in a high tax bracket, it makes it even more valuable. So I know I went through that fast at the end. I hope this makes sense. Let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much.